Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. The stock market has been trying to put together a string of as many consecutive gains as possible lately, albeit amid very high volatility. So that raises the question again, bull rally or bear trap? And you know by now that our roster of market watchers always has an answer to that question. Weighing in on this for us at this edition of the Round Table, unfortunately Steve is not here. In his seat, Charles Roeplet, Zacks man about the markets. And then Mike Vodicka. Mike watches the momentum stocks for us at Zacks.com. Slipped my mind what exactly you did there for a minute. And then, of course, Zacks maestro of stock screens and chief technician on the markets, Kevin Matris. So, Mike, welcome to this edition of the Roundtable. It's the first time here, by the way.
Yes, it is.
And if you have anything to say about it, maybe your last. how these two guys react here on either side of you. But you heard me say very high volatility. That's what we've been seeing in the markets here since the beginning of November, at least, end of October. And sometimes that is a harbinger of good things to come, a lot of people feel. Because when you've got a lot of volatility, especially volatility at highs, historically, volatility occurs within 1 month of major bear market bottoms. That's been going on since 1960s. What do you think?
Well, I think part of the volatility it's been overshadowed because everyone's seeing these day-to-day moves. And what's being lost is really since October 10th, we've really been in a trading range. For the Dow, we're looking at about 8,200 to 9,450. And we're seeing this range really replicated across several major indexes. I'm using the Dow here as an example.
Okay.
But I think it's important for people when they look at these day-to-day swings, and they are large. We're seeing swings of 200-300 points a day.
Right.
And a lot of times those moves are even bigger, and a lot of times those moves are happening late in the day.
500, 600, 700 points.
Yeah, exactly. And so the thing is, if you're looking at an investor every day, you're like, oh my gosh, the market's moving here, it's moving there, what do I do?
Right.
But if you step back and you kind of look at really what the trend is, we're really in a large trading range, about 1,250 points on the Dow, and we've been moving up and down through that. So we really have seen some type of stabilization in the markets, although it sure doesn't feel like it with these day-to-day swings. When these day-to-day swings might end, it's anybody's guess. I kind of think we'll actually go from this to a point of maybe flatter trading with a tighter range. But for right now, we are looking at range-bound trading by a very large and big range with some volatile moves within that range. But we have actually settled into a trading range.
But that, too, can be a good thing. That can be a positive
Right.
as the market tries to put in a bottom, right, Kevin?
Right.
Technically speaking, I mean, that's kind of what we look for, isn't it?
Yeah. I mean, if you were to look at the major indexes, you know, Charles, he showed a graph of the Dow Jones, but if you were to look at some of these charts slightly differently, if you were to look at the Dow Jones, the S&P, and the NASDAQ, and you were to look at a line chart, you can see that they are consolidating, like Charles has shown on that chart. But you can also see the beginnings of an inverted head and shoulders pattern. In fact, it looks like it is near a completion of the inverted head and shoulders, and an inverted head and shoulders is typically a bullish pattern. Mm-hmm. When you combine this with the bullish divergence that you see on the relative strength index, there's a lot of people believing that this are signs that we finally have been able to reach some degree of stabilization and that we may be able to start pressing higher. Is this going to be the beginning of some, bull rally where we never look back? That I don't know. But I do want to say that these patterns, all of these patterns, nothing is infallible. So we may see this consolidation pattern break down just like any pattern can. But thus far, there are many, many reasons to believe and many, many reasons why investors are getting excited and maybe expressing some relief that we may be able to start moving higher in a meaningful way.
Well, historically, market bottoms out 3 months before a recession ends.
That is right. If you look back at the bear market that we saw back in 2000 and 2002, the market hit bottom in October of 2002, and then we saw the market start to rebound. The rally really started to get going in March of 2003. What's interesting is that you didn't see unemployment peak until July of 2003. So the market found its legs far before the economy started to look brighter.
All right, Michael, we've got a confirmation of volatility from Charles. We've got a definite I don't know What do you think here, bull rally or bear trap?
Yeah, I personally see a bear trap. I understand what Kevin's saying about the market rebounding before the fundamentals bottom out, but what we're seeing on a fundamental level is the data continues to weaken, and there's a couple of key points I want to point out is that number one is you're looking at what's happening with the job situation here. The most recent report on non-farm payrolls, we shed 240,000 jobs in October. September, it was revised upward to 284,000. And just in the last 6 months, the economy has dropped 651,000 jobs. We're up to 1.2 million lost jobs for the year. That's a pretty big deal. American Express cut 10% of their workforce. They dropped 7,000 jobs. The auto industry is having big problems. They're shedding jobs. So we're seeing significant job loss. To me, that's one of the most significant drivers here on actually reaching a bottom for the market. And then another thing I'm looking at pretty closely is the housing market. The Case-Shiller S&P Housing Index, which came out the most recent report came out last week, it said the housing price is down 16.6 year over year. Housing prices are now down over 20% from their peak second quarter of 2006. So the residual effects of job losses and depreciating housing prices is consumer confidence is at a low point right now. The most recent reading on consumer confidence came in at 38. That's the lowest it's been since the recession of 91 and 92. And what's important to remember is that GDP is really a consumer-driven index. GDP is 2/3 consumer spending. And as the consumer feels pressure, we're going to see additional economic contraction. And I think that's going to put pressure on the overall stock market.
Really?
That's not to say that there aren't going to be segments of strength in the market. There will be, but it's going to take a more strategic, more targeted approach to find those stocks.
But it's important to realize every recession is different than once before. We've never had government intervention the way we have it now, ever.
Okay.
Well, I mean, that's the bearish argument, though. I mean, Charles brings up a good point, and with his point, that is more bullish because it is unprecedented, not only from the U.S., but also from the global community. The bearish side is that, we really are in an unprecedented crisis situation. People are calling it a financial tsunami. I think it was Greenspan, or maybe it was Bernanke, said that this is a once in a 100-year crisis. So while you can look at the past and you can look at the technicals for some kind of semblance as to what's going to happen in the future, the situation that we're going through really is something that we haven't really seen before, not just in a long time, but almost never.
All right. So do you agree with Mike, though, both of you guys, that the economy is going to keep a lid on any stock market recovery here? It's going to put downward pressure on the market?
I think in the short term, Mike's more bullish than is more bearish than I am. We've talked before. I kind of think we will see a recovery sooner than later, but when we look at the second half of next year, it's anybody's guess as to what the economy is going to look like, what the market's going to look like, and it's interesting when we look at earnings estimates for 2009, they're really all over the place. If we look at the most bearish forecast for every company in the S&P 500, and then we combine those to come up with a number for the S&P 500, we're looking at about $71.60 is what the S&P earnings are going to be next year, which is a decline from current levels. If conversely we look at the most optimistic forecast for every company, we're looking at earnings of $111. So you're looking at a $40 spread. And obviously I think the most optimistic forecasts are way too optimistic. Probably some forecasts that haven't been really revised to reflect the credit markets. But I think it goes to show that most analysts don't know what earnings are going to be like for next year. Right. And it's not their fault. They're trying to deal with really incomplete data. It's really hard. We have no visibility for the second half of 2009. And we could get a recovery by then. We may not see a recovery till 2010. It's really difficult to say. But it is fair to say we will see stocks recover before the economy does. And that's a key point investors need to keep in mind.
Okay. And so that would follow the normal pattern of recoveries in both the market and the economy. Anybody here want to give a number for the Dow here? Bottom. Well, we don't want to call it the bottom, but we try and do that every once in a while. I know you've been kind of bragging that your predictions have been holding.
Intraday low of October 10th still holding. I believe it was 77.82, and we have not retested that yet. Knock on wood. We'll pretend it's wood.
Yeah, it's simulated wood. All right, I don't want to put you on the spot, but I know Charles.
We're going to put you on the spot.
Charles just itching to get that number out, so I figured if he did,
I've been right for now 30 days.
The one thing I would say, and you're going to follow up. The one thing I would say is there are going to be a lot of bullish opportunities. The kind of collapse that we saw in October. I mean, 70% of the trading days days in October were down. So the kind of falling knife scenario that we had seen last month, I don't think we're going to see that replicated anytime soon. Yes, there's probably going to be some additional pressure on the market because of the deteriorating economy, but I still think that there's going to be plenty of bullish opportunities moving forward.
All right, we say bear trap. I just want to close on this note. We say bear trap, but should we really be saying bear rally? Because these are opportunities, right? These bear rallies?
Well, they are opportunities, and I think it's like I said, I think we're more in a trading range as opposed to a bear trap or a bear rally. I think we actually have set the low, and I think we're going to hold it, barring the economy getting severely worse, which I don't think it'll occur. I do think, obviously, we'll have negative GDP this quarter. We'll have negative GDP first quarter. Beyond that, we'll have to see. Unemployment will rise, but I don't think we're looking at the, as Kevin said, a tsunami that some people are talking about. This is not a situation where dogs and cats are going to be sleeping together in the next few months. I mean, things will get worse, but I don't think we're looking at, depression levels as some people are trying to proclaim. We're far away from just even a severe recession, even on unemployment. Typically, you see 10, 12%. We're at about 6.5% right now. So unemployment could get 50% worse, and we're just borderline severe recession at that point.
All right, I want to give Mike the final word because now
Sure.
we've got range-bound from Charles. I don't know from Kevin.
Yeah, I'm actually looking for the major indexes to test their lows, and I think that's going to be predicated upon weak retail sales and additional job losses. But like Kevin said, the capitulation we saw in the market in September and October, they really have created some compelling valuations, and so there are good opportunities for good stocks right now.
Okay, at least we've come across with that. There are some good opportunities
Right.
amid all of the volatility that we've seen. Our thanks to Kevin Matris and Michael Vodicka and Charles Rotblatt, and to you for tuning in to this edition of The Roundtable. I'm Terry Ruffalo.